Welcome. Welcome, everyone. And let's do our traditional thing. If you don't mind, please unmute yourself. Let us know where you're calling from. Go ahead, don't be shy.
Santa Monica,
Houston,
California.
Texas.
Texas,
Chicago.
Houston, Ali.
Yes.
Santa
Anyone
Monica,
else?
California.
Hey, Karen from California. Welcome you.
From Phoenix.
Charles,
Charles Willis by way of Alabama, by way of Chicago.
all right, Charles, welcome you here. Welcome you. Anyone else?
Houston, Texas.
Who is this? Lee? Debbie from Houston, Texas. Welcome, Debbie. Welcome,
Yes.
Debbie.
Hi.
Okay, great. Oh wow, JT from Hawaii. Wow, we're all the way to in Hawaii now. We didn't even know that we have people in Hawaii. We definitely need to make a trip to Hawaii.
Yeah, we need to find somebody in Alaska.
Alaska. Okay, great. Absolutely. Okay, good. Let's start the training. Okay, we're on recording. Okay, great. Well, welcome everyone. Tonight definitely it's going to be a very exciting night. And after all the preparation, I believe that finally Sequoia it's ready to pre-launch this company. We are going to make the announcement later on after the presentation. So today's agenda is such this. The first portion, same thing. We're going to have the training by our advisor, Mr. George Franco. He will be sharing with us not a new program, but new guideline for fix and flips. A lot of the lenders are coming out again, and fix and flip is actually a very competitive space. So a lot of the lender are doing a lot of things very creatively. So if you have clients that need funding to purchase investment property, purchase property that and also need renovation, and then sell it, though the fix and flip is definitely the way to go. So George is going to share with you what this new guideline is. And by the way, if you don't know who George is, now normally George do not be on camera, but today it's a special treat for everyone. So George is on camera now. You can see who he is. George is it's a lender himself. He knows this space very well. So today, the first portion, he will be sharing with you what that new guideline is for fix and flip. Then after that is done, we will be announcing the new contest for the summer. The new contest for the summer. So I'm going to leave that to later on. And also, we are going to introduce you our new partners in Chicago. Wesley is the representative, and he will be here to share with us some very exciting news with the company. So again, without further ado, George, the floor is yours. Let us know what you got.
Well, thank you so much. Let me share the screen here. Alan, can you see my screen?
Not yet. Now I can see it. Now it's good.
Okay, perfect. Okay. Good evening, everyone. George Franco here. As Alan mentioned, I'll be explaining some of the fix and flip funding options. This space is getting very competitive. It's always been somewhat competitive, but today we'll go over some new program guidelines and some things hopefully that'll get you more business in this space, the rehab, renovation, fix and flip stuff. For those who may not know, just a quick brief introduction into it. What is a fix and flip loan? It's basically a loan that is a short-term loan, typically 12 months or less, for investors to buy, renovate, and sell properties for a profit. It typically covers a significant portion of the purchase price and rehab costs. And you'll hear other names for it, such as rehab loan and renovation loan, but it's all in the same family. Fix and flip, rehab, renovation is all the same thing. How does it work? Well, basically, depending on your credit and experience and quality of the deal, the lender will give you a certain percentage of the purchase price, typically anywhere from 70 to 90% of the purchase price and up to 100% of the renovation, which basically is held in escrow and released in draws as the work is done. So I've explored the top 3 options for this kind of funding. We wanted to present you guys with, again, more opportunities to make money in this space. And so we kind of got the more aggressive lenders out there to give us these terms here. None of these terms require income tax returns. Nothing's income driven, nothing, no personal income tax returns, no pay stubs. It's just basically the contract. A lot of times the contract, the rehab budget, the LLC docs and insurance and title, not much else. The first option is 100% funding and no payments. Go back. Basically, what that means is this lender, option one, will cover 100% of the funding from 100% purchase and 100% of the renovation budget as well. This is good for borrowers who want to put down as little as possible. And also the big feature, really big, is there are no monthly payments. The interest accrues until payoff. So basically, there's no monthly payments. Everything just accrues until the minute you pay off. They'll calculate how much you owe, and that'll be it. That'll be added to the payoff. But then there's nothing you have to come out of pocket with. Option number two, 90% of the purchase. The good thing about this one, doesn't require an appraisal. Again, it's a very high leverage. You get 90% of the purchase price, 100% renovation. You only need to put 10% down plus closing cost. The practical part about this is it can close fairly quickly. Again, no appraisals required. And we'll get into the more reasons why that's attractive, but ultimately that is going to be something that you can sell and pitch. Hey, you can close fast, no appraisal. The lender is going to give you a term sheet based on their comps, and there's no guesswork involved here. The third one is 90% of purchase as well, except for those borrowers interested in the lower interest rate. We can get it down as low as 7.99. The lowest rate I found in the market today is around 7.99. So this actually gives you the opportunity to pitch that and sell that. Borrowers who are interested in rate, because some people are rate sensitive, this would be a good option for them, and we'll teach you how to get there as well. Now, the first option, 100% funding to qualify, it's pretty simple and straightforward. Need at least 4 projects in the past 5 years. And 5 years is generous because a lot of lenders only go back 36 months or 3 years. And so this lender actually goes back 5 years to as far as what we call look back period, which means if you can demonstrate you've done projects in the past 5 years, at least 4 of them, you can qualify for this. The other criteria, of course, is credit score. 680 or higher gets you into the program, and the profit margin of 12% or higher. That number is something they calculate internally. It's fairly simple, but there's a spreadsheet I created to actually calculate that. So if anyone's interested in that, I can definitely send that to you, and you guys could figure that out yourself. But a lot of times what happens is someone may have the four projects and this credit score, but the lender doesn't accept the 100% funding, and it's because it's a profit margin thing. So we'll definitely, if you're interested in that, I can definitely send you a spreadsheet to help you calculate that so you know exactly. Okay, the benefits of the 100% program, of course, 100% purchase price, that's great. I mean, you get all of the purchase price money. You cover 100% of the rehab budget, so both the purchase price and the rehab budget are covered. The lender also does something different. They actually cover their own fees. So basically their points, their fees, and the broker fees, which is Sequoia fees, are all part of the loan, which is really great because that means that there's less money needed to close the deal. Keep in mind that this is all financed as part of the loan. It's all rolled into the loan. And so basically all the borrower needs to bring at this point are closing costs. That's just it. Closing costs, which would be title company fees, insurance, taxes, whatever's on the HUD. But basically that's a very minimal down payment or minimal out of pocket to close. And again, the big added benefit on this is no monthly payments for the lifetime of the loan. This lender allows you to have 4 deals at one time. So basically, to begin with, now if you start off with 4 deals, you don't have to make any payments on any of these deals. Everything's just accumulating until you pay it off. Once you pay 1 loan off, they'll allow you to have 10 loans at a time. So imagine you can have 10 loans going on with this particular lender with no monthly payments, which is huge because I've been in this business for a long time, and monthly payments, if you have a lot of projects going on, can really be costly. So this feature here is excellent. The experience window, again, like I mentioned, is 5 years. And so basically they go back 5 years, which is really huge because a lot of lenders will not go back that far. They'll only go back 3 years or some even 2. And a GC license, if you have a contractor's license, that counts as 2 projects. So if you've only got 2 projects, but that GC license, you can qualify for the 100% program. The general characteristics of it, 100% funding is typically done using 2 loans. And so basically it's a combination of 1 loan, which is usually going to be 80% of the project cost. That rate's going to be around 10.5 to 11.5 roughly. The second loan is usually 20% of the project cost. So they combine these two, the 80 plus 20 to make the 100. And the second loan is going to be usually at 18%. Now that may seem high, but typically that's going to be the smaller portion of the loan, and that actually completes the 100%. Term is usually 12 months, no prepayment penalty. So if you paid off early, say you paid off in 3 months, 4 months, again, no penalty. You could just, all they do is calculate the interest until that point. And again, deferred payments, no payments for the duration of the loan. Some of the issues we've had in the past with this particular loan has been the appraisal report. Sometimes you have to prepare the clients for this. They may say, hey, this property is going to be worth, let's say, $500,000 after it's renovated. That has to match the appraisal report. Sometimes the appraisal comes in lower, and that will change the dynamic of the deal. And we have to let these borrowers know that, hey, that can happen. Something else to look at, this lender recently hired a construction manager to look at every single budget that comes in. So if you're saying, again, the property will be worth $500,000 in the future, they're going to want to see that the work that's being done is going to be consistent with the comps that are in the 500 range in that particular market. So if that market calls for hardwood flooring, quartz countertops, whatever the case is, they want to make sure that that's included in your budget as well before they can give you the 100%. So again, these are things to remind the borrower of, that these things may change. They're all subject to the appraisal report and of course the budget and credit and so forth. But the main challenge we found as far as people not qualifying for this once they meet the credit and the experience has been the appraisal report and the rehab budget being not so thorough. Now, number two, 90% funding, which is 10% less than 100, of course, but it gives you a great opportunity to only put 10% down plus closing costs. To qualify for this program, at least 5 projects in the past 2 years and a credit score of 700. Now, the benefits of this, it covers 90%, which is great, covers 100% of the rehab budget, again, great. But the key here, no appraisal is required. The lender will pull their own comps before issuing a term sheet. Why that's important? Because the previous example that I mentioned, the appraisal can kill a deal. If that comes back low, then the dynamic changes and this person doesn't have enough money to close, and that kills the deal. This lender here will actually pull the comps before they issue a term sheet. So when you get a term sheet, that term sheet is solid. So the numbers will not change. So there are no surprises, no changes during the process because they've already established what the value is. They're not going to change on that. That term sheet is going to be real. And so the numbers will be the numbers. As long as the credit comes back okay, the background and the experience, they can check that out. The numbers will stay the same. The great thing about this loan also is speed. They can close within days. The lender mentioned they had a deal that closed in 1 day. They had a full package. They had everything they needed. They closed in 1 day. I don't expect that to be the case every single deal, but we've done deals with them in about 5 days or less. And so definitely, again, this is for speed and high leverage. The rate, as far as the pricing, is going to be 10.99, so it's a little bit elevated. However, again, it gets you what you need as far as the speed, the closing, and not having to worry about the appraisal coming back low. A 12-month term, no prepayment penalty, and the amounts are between $75,000 to $2 million. Now, another important thing to think about is this is a non-Dutch interest loan. You're going to hear 2 terms in rehab funding. One is Dutch and non-Dutch. Dutch basically means you're paying interest on the entire amount from day one. For example, the first lender combined those 2 loans and actually is holding the money in escrow, you're paying interest on that entire amount from day one. Whereas this lender here, if you have 50K sitting in escrow for the rehab budget, you're not paying interest on that money until you begin to take it out. So once you request your first draw, you start paying on that money. For example, if they have 50K in escrow, you request, say, for example, 10,000, you start paying interest on that 10,000, not on the 40K because it's still sitting in escrow. Once you begin to draw more from that account, then you'll start paying money. So your interest actually will change month to month depending on how much you take out from the rehab budget. Option number 3, this is for people who are rate sensitive. We can get the rate as low as 7.99. I think right now, if you look online, you probably see the lowest rates that I've been able to find. And I think that's existing now as of today, June 4th, is 7.99. For this lender to qualify for that rate, you need to have at least 3 projects in the past 3 years. You need a credit score of 700 plus, and that actually puts you in that bucket to qualify. The benefits for this program, it covers 90% of the purchase price, 100% of the rehab budget, again, high leverage, and you can buy down the rate to 7.9 by paying 1 point in addition to what they normally charge. Another great feature about this loan here is you can use your own appraiser. Now, if you've done rehab loans before, the lenders typically want to order the appraisal themselves, and they are very strict about making sure that they use their own people. this lender will allow you to use your own appraiser. Now, the caveat to that is you actually have to get that appraiser to sign on with their AMC. So AMC is an appraisal management company. You may hear that term a lot. That is what lenders typically use to order appraisals. So it's like a third-party company that actually manages that process and actually puts a bid out for appraisers to, to make the appraisal get that job and go out and do it. So for example, I mean, I know someone in, say, Kentucky, and I need an appraiser there. I would hire an AMC. I put the order through AMC. AMC puts a bid out to all the appraisers that they have in their network in Kentucky, and we get the appraisal done. So you can actually, if you have an appraiser that you work with, that you're familiar with, that you know well, you can actually use that person as long as they're willing to sign up with that AMC. Now, it doesn't mean that you get, they're still going to check everything. It doesn't mean that you have your appraiser and they're going to give you a high price, elevated price, and they're going to go with it. It means that they're going to take that appraisal report. They still do a appraisal review. So it's not like, again, you're free reign to just pick your value. It just basically means that you can use that appraiser. There's still a quality control element to it. The AMC will review it, make sure the numbers are consistent. But again, it does give you an option. So there are no less surprises down the road. At least you know this appraiser and you'll know what the quality of their work. Typically, the range here is going to be 7.99 to 10.99, 10.99 being on the higher side if you don't buy down the rate. But if you're able to pay 1% to buy it down and get down 7.9, 12-month term, no prepayment penalty. The loans here are 100,000 to 1.5 million. And again, the same thing, non-Dutch. Now, I reiterate non-Dutch because a lot of lenders, they charge you interest on the whole amount from day one. These last two lenders here, they will actually allow you to just pay money on whatever is in place. So if you have, again, Rehab escrow, 650,000 sitting in escrow, you don't have to pay anything on that until you begin to draw from it. Really key difference because it saves you a lot of money month to month. We also have for those who don't fit the bucket, say for example, rural properties are a big one. We get sometimes requests for rural properties, we still can do them. The issue with rural properties is that the LTV is going to be lower. So instead of the 90% or 100% that you qualify for with the typical renovation project in a major city or major metropolitan area, rural properties which are out in the middle of nowhere or have a low demographic, it can actually qualify for 80%. You need about 20% plus, closing costs to close this. But again, it's doable. First-time rehabbers, a big one too. Some lenders do not like first-time rehabbers. They want people with experience. We can still get them done. The only difference, of course, is they don't qualify for any high leverage. It's too risky. A lender is going to give them typically between 80 to 85%, which means they need about 15 to 20% plus closing costs to close the deal. And the other one, the bucket that we have, low credit borrowers. I'm pretty sure you guys come across those individuals as well. The LTV, of course, would be lower due to the credit score, but we still get them done. We can get with any credit score at least 50% to 75% of the purchase price plus closing costs. So they can still apply, we can still close them. However, they're going to need more money to close, obviously, because they're higher risk category, and so the lender is going to want to feel safe by requiring a bigger deposit on these things. A couple of case studies as far as what we've encountered in the past and how we able to overcome some of these issues. Borrower, for example, has bad credit, lots of experience. This is actual case studies we actually closed on before. We recommended they partner with someone who has excellent credit, and they were able to get the deal done. What happens in these cases is the lenders allow two people to come together and actually be co-signers. So if the person has bad credit, but they've done about 10 properties in the past 2 years, they can actually team up with someone who has great credit but with no experience. That person with good credit doesn't have to have any experience whatsoever. As long as they're willing to co-sign on the loan, as long as they're willing to be a guarantor on the loan, these two can come together and actually get the higher leverage, which basically means that 90 to 100%, LTV. Second scenario, borrower didn't have enough cash, but had other properties with equity. In those cases, again, because sometimes people come to the table and they don't have liquid cash. It's not in the bank account. You may see the bank account, or you may say, hey, how much do you have to work with? And they may say, I don't have much, I don't have anything. But if they have other properties, we can actually work with that. So these properties have a lot of equity. Say, for example, they're owned free and clear, or say they have a low mortgage balance on them. We could actually use them as collateral to either cross-collateralize or to do a quick cash out refi to get the money so they can actually close, with that cash out refi. And another one, borrower needs to close fast. We actually had a deal where the borrower needed to close pretty quick. We got her approved for a loan and was able to close in about 6 days or so. Once of course, title work had to be ready and so forth. But going back to lender number 2, which we talked about with option 2, again, they can close pretty quick as long as the title work's in order, as long as the person checks out as far as the credit and their experience, then they're ready to close. They can close pretty quick, and we were able to do that. So these scenarios here, again, people come to us and they have to close quick. They don't have credit, they don't have experience, they don't have money, whatever the situation is. Please feel free to have them fill out the loan application or call us, and we'll be able to create a solution out. Again, Sequoia, we're known for solutions. We pride ourselves in finding solutions. These deals that some deals that come to us have been around for a long time. Alan knows this. People come to us, they've been shopped the deal around for sometimes many, many months and couldn't get it done. We're able to actually find a solution for them. So definitely, even if it looks like it's a deal like we can't do or that can't be done, please give us a call or have them fill out the loan submission form, and we'll be able to help them out. That's it for this fix and flip funding. This is my information here. If you have any questions on any of the programs I mentioned or anything you want to talk about, please feel free to give me a call. Also, my email here is loans@sdqlending.com. Again, if you have a scenario or anything that you want to discuss relating to 1 to 4 single family, small balance commercial, fix and flip, cash out refis, please go ahead and feel free to contact me. Be happy to help out.
Okay, great. Thank you so much, George, for your beautiful
Absolutely.
presentation. As you can see, fix and flip is one of the bread and butter type of loans for us. We fund a lot of those things. And I think in our pipeline right now, currently we have at least like 10, 15 of them are fix and flips and in different various stage. So feel free to, again, market this type of program. Normally when people come into commercial lending, we all have the illusion that, hey, let me hit that $10 million deal. Let me hit that $20 million deal. Now, all those deals are good, but honestly, it takes forever to get them close, and you go through a lot of headaches to get them close too. The low-hanging fruits are fix and flips, 1 to 4 unit investment properties, because again, this type of deals are very, very easy to process. Uh, Most of the clients that come to us are not bankable, meaning that they already been to the bank, somehow, somewhat they cannot get a loan done, come to us, we get this thing done in about what? We can get this thing done anywhere between what, George, what would you say? Anywhere between 2 weeks
Yeah, depending
to
on the
3 weeks?
situation, as
Right.
little as 5 days, but typically on average, though, they take about between 2 to 3 weeks. But one thing I want to add to, Alan, even if they are bankable, even if someone has great credit and the house needs work, the banks are not going to lend money to them. So it doesn't really matter. You can have 800 credit score, you can have
That's
all the
correct.
money in the bank that you want, but if the property is in bad condition, the bank will not touch it. So they need a rehab loan, and there's no product out there that does as far as there's owner occupied money out there conventional wise, but as far
Yep.
as investor, this is the way to go. So yeah, we have those loans and we have different products to fit each scenario. So please, any situations that you have, absolutely bring them to us.
Yep. So this type of loan, you can get your paycheck in 30 days.